Welcome to Keep What You Earn, your judgment and jargon-free zone for entrepreneurs of all levels. Get ready to learn how to scale your business, save money in taxes, and create a business that grows your wealth. If it feels like the financial side of business is like eating your vegetables, well, then think of this podcast as the ranch dressing to make the process a little more enjoyable. My name is Shannon Weinstein. I'm a CPA and business owner on a mission to simplify money and empower others through knowledge. I hope this episode inspires you to take action, but remember that the information we share is for educational purposes only and is not individual tax advice. Now that we got that out of the way, let's start the show. So I have a kind of non-traditional belief around quarterly estimated taxes. And before I dive into that, I just want to say that, a lot of what I express on this podcast and a lot of the information I share with you, some of it's based on, what I've learned. Some of it is my opinion. And my opinion is only worth the value you assign to it, right? Because there's so many people with different opinions out there. And one of the fun things about being in this profession, working in taxes, working in accounting, is that we're given a set of guidelines, but there is such a spectrum, such a way to interpret those guidelines and ways to kind of apply your own approach. It's also what makes it uniquely interesting in how you work with a professional and why just hiring an accountant isn't enough. You have to find someone who really connects with your approach and your risk tolerance and your preferences. So as I'm diving into this, just keep in mind that this is how I feel about quarterly estimates, and this is how I feel about my approach and what I sometimes recommend to clients. And the intent of this episode is to make you aware that there are different ways to think about things, whether you take this approach or not. So I'm not telling you what to do. I'm not telling you what to do, but I am telling you to think about this and keep this in mind as you examine how you approach your own business and your own tax situation. So one of the things that I actually discouraged this year was my clients paying their Q1 and Q2 estimates almost across the board. And it's going to sound funny. Like, why would you do that? Isn't that kind of against the whole point here? And I'll explain why. So when we talk about quarterly estimates, these are supposed to be, the quarterly estimates are estimated amounts that you're going to owe on money you haven't paid taxes on yet. So when we are employees, we pay taxes as we go. We had them taken out of every paycheck, right? But when you're a business owner, you have the responsibility to set aside the tax money because you're the one who knows how much profit you've made. So the most important thing, and this is super relevant for this particular episode, is the most important thing is that you have good bookkeeping, meaning your profit at the drop of a hat. You can go get your profit numbers. They are readily available on demand for you. And number two is that you fully understand how to save money for taxes and you have a vehicle to do that. So we recommend, and I've mentioned this in past episodes, especially the bank accounts episode, we talk about setting aside, somewhere between 25 to 30% on average of your profit for taxes. Now, this, by the way, could span anything from 15 to 35%, but I lean into that kind of range to give you a better idea and to say, well, if you're doing 25 to 30, you're probably in good shape and you're probably getting closer to that bullseye. So if you are saving money for taxes, if you are setting aside that money, not touching it, being disciplined and treating it with respect, then for me, that is the most important thing. Because if you're setting it aside, then you're not going to be blindsided. Setting aside that money will immediately reduce stress because it will be somewhat automated. You'll be used to it. You'll get into that habit, that routine. You will be operating off of the rest of the money and it won't really bother you. Kind of like when you made a paycheck and you didn't even realize that like 30, 40% of your money was getting taken out every other week. So why did I tell people not to pay their estimates then? Because if they're saving the money and we have a good grip on their profit, which of course we do, we're working with them, then I say, okay, listen, we have a couple choices. that 25, 30% of profit, you could pay, it's Q1 or Q2. You could pay what you think you owe. You have that set aside in the bank account. You have that. You could pay it, or you can hang on to it for a little bit longer and see how the rest of the year goes. Why would you want to do that? Because there can be variability from quarter to quarter, especially if you're listening to this and you run on launch cycles. So if you're launching in a particular quarter, but then you have a quiet quarter, right? Not every quarter is created equal. So if you had a bang in Q1, this is what I want to look out for. You have bang in Q1, nailed a $100,000, $200,000, $300,000 launch and took home most of that in profit. And you had like $100K profit in Q1. Then you had a quiet Q2. You reinvested a lot of money and you ended up with a $20K loss. And then Q3, $30K loss. Q4, say you broke even. That means, and you don't have to do the math, that means at the end of the year, you had a $50K profit. Now, here's the thing. If you had saved 25% of your $100K profit in Q1, then that means that you had $25,000 in the bank account set aside for taxes. Now, if you paid that estimated payment back in Q1, that means you would have paid $25K in taxes before you knew how the rest of the year was going to go. And the rest of the year brought you down to $50K, which means that at the end of the year, when we wake up on January 1st, your numbers look like this. Like you paid 50% of your profits in taxes because you paid $25K and you only made 50. So what happens is you get that money back. That's called a tax refund, by the way. That's how tax refunds work. Because when you pay a little bit too much, you overestimate what you're going to owe. You pay too much in and you get some back. Now, that's all well and good. You get a tax refund. People like that. People like to get that money back. But what could that money have done for you if instead of paying it to the IRS in Q1, instead of letting control go of that money, you reinvested it into something else? You invested in the market. You invested in real estate. You invested in your business, anything. What if you took some of that money and invested it? Now, I'm not saying, again, you should save it for taxes, right? You should save it for taxes. But once Q2 hit, for example, and you realized, ooh, that's, $20K loss. Now we're down to 80. You could take some of that money out, right? You could readjust the balance of your tax savings account to align with the year-to-date profit. So you could take some of that money out and invest it. So what I'm saying is Q1 and Q2, it's good hygiene to be ready to pay those quarterly estimates. But my general advice I tell my clients most of the time, and this is, I say most of the time, because there are some clients that I think should pay it regardless because they make so much money. We never want to hit their cash flow too hard by having them pay a huge amount all at once, right? It's all in how you approach it. And there are some clients who just really prioritize and want the peace of mind. And this might be you, that want the peace of mind to know it's handled, it's paid. I'm not going to get a bill. No one's coming after me. No one's waiting for me. And that's totally fine. There's nothing wrong with that approach. But what I'm saying is, for those of you who like to just know the rules, hey, am I supposed to pay quarterly taxes? Like, I'm trying to check all the boxes here. I'm trying to set up my taxes properly as an entrepreneur. What am I supposed to do, Shan? My answer to you is, you're not supposed to do anything. You have a choice. The IRS wants you to pay those quarterly estimates. In fact, you'll get a penalty, a very small underpayment penalty, if you do not pay those quarterly estimates. Now, to be honest with you, that penalty is extremely low. People think it's going to be higher than it is. Most people don't even feel it. It's like a little poke of like $100, $200. And, yes, it's an avoidable penalty. Yeah, why not pay it to avoid the penalty? That's a legitimate thought. On the flip side too, is it worth a couple $100 for you to keep control of several tens of thousands for a little bit longer? Especially, and consider this, especially because we're in 2022. And this advice could change. My opinion could change. But in 2022, there's a lot of uncertainty. There's a lot of volatility. People are losing money in crypto. People are losing money in the markets. Interest rates are going up. Inflation is increasing. We don't know what's coming. We don't. But there's a lot of talk of this word recession. There's a lot of talk about what's going on with the economy. And the last thing I want for you is for you to lose all control of your money, your cash, because you paid a crap ton to the IRS earlier this year. So I really like to sit back, listen, and watch and see how the year is going before I overcommit a lot of money into my tax fund. I was profitable every quarter this year. I haven't paid any estimates yet. I haven't. I have the money set aside, but I haven't paid it yet. Why? Because I'm waiting in the wings going, let me just see how this is going to all shake out. Because maybe also keep this in mind. If you do proper tax planning, Q3, Q4, and you meet with your accountant, come up with some strategies, realign, invest some of that profit back into the business. So, you've been eyeing you had your eye on this coaching program that you want to enroll in, or this opportunity comes up around December, January. And at the end of the year, you invest a lot of money in something for the next year, something for 2023. Well, cool. That just depleted your profit, which again, you're spending money. Make sure you're spending money that you intended to spend anyway. Don't spend it just to spend it, just to lower the profit. But if you can strategically time that expense into this year and reduce your profit, now you're reducing what you owe in taxes as well. So if you can get strategic about it towards the end of the year, you could reduce your tax liability as well. So basically what I'm saying is don't throw the dart too early, because the longer you wait, the better your aim. The longer you wait, the better your aim. It's almost like it's a dartboard and you're, 1,000 feet away in January, 12,000 feet away, right? And then every month you get closer to knowing where the bullseye is, to being able to see it, to being able to throw that dart. And you don't have to wait until December. God, you don't have to wait until December, January to make those payments. But as you get closer to that Q3, Q4, you definitely have your sights on where that bullseye is, and you can get much closer than if you threw it in January. That is my point. So that is why I have been coaching my clients through the idea of not actually making that money transfer to the IRS yet. And again, not advice to you. I don't know your situation, but think about that as an approach for you. And again, I highly recommend this approach only if you have a mechanism to save those taxes, you're responsible about saving those taxes, and that you're able to manage that process, and that you have good bookkeeping to know what your profit is so that you can measure this and that you can plan ahead. It's why every single foundational thing we teach is grounded in good bookkeeping. So if all of that is in place for you and you're looking to plan, you're looking to do tax planning, tax strategy, and really hone in on getting this right and really nailing that bullseye, then that is the time to start talking to us, talking to a tax strategist. Hit me up on Instagram. I'm at Shannon K. Weinstein. Share this episode with someone that you think may benefit from this perspective. Share it on your stories and make sure you tag me. All right. I'll see you in the next episode. Most accountants will try to bill you for those quick questions or make you feel like you're bothering them. And the truth is that the quick questions are what I love about what we do. That's why I created a new and accessible offer for you to be able to message me your questions and get the support you need when you need it. It's called the CFO On Demand. You can now get affordable help and access to me and my team without a high monthly fee. You can also upgrade and get access to a private one-on-one office hours to bring your specific strategies to the table. Want to learn more? Head to thecfoondemand.com or click the link in the show notes. Again, that's the CFO On Demand. Thank you so much for listening. If you enjoyed this episode, please leave a rating and review on your podcast platform. This small action goes a long way for podcasters to get our message heard by more business owners just like you. Be sure to check out the show notes for links to information about our guests and ways to get in touch with me. We'll see you on the next episode.